You're sitting on a potential £130 a month, maybe more, and you haven't claimed a penny of it. Not because you don't qualify, not because it's too complicated, but because of one word. That word is benefit. When most people in their 60s hear pension credit or council tax support, something shifts inside them. There's a quiet voice that says, "That's not for me. I've worked, I've saved. I don't take handouts." I used to think exactly the same way until I ran the numbers for my own mum. Every single pound that comes through these schemes was funded by the national insurance contributions you've been paying since your first job. It isn't charity. It's an earned top-up from a system you've spent decades paying into. In this video, I'm going to walk you through exactly how much you could be missing using a real couple's situation. By the end, you'll know 3 numbers that matter and why every month you wait is costing you more than you realize. The Department for Work and Pensions has tracked this for years. Right now, around 850,000 pensioner households in the UK are entitled to pension credit, but not claiming it. That is roughly £1.7 billion sitting unclaimed every single year. For an average eligible couple, that works out to about £3,400 a year in extra income they never see. Now, why? These aren't people who don't know how to fill in forms. Many of them are organised, careful, diligent savers. The reason they're not claiming is simpler and more stubborn than that. It's the word on the front of the form. I've watched this happen more times than I can count. Someone comes across a government leaflet about council tax support or pension credit. They read the first line, they see the word benefits, and they close the leaflet and move on, because somewhere along the way they've absorbed the idea that claiming means you failed, that it's an admission of need rather than a return on 40 years of contributions. But here's what makes this particularly costly. Pension credit isn't just money in itself. It acts as a passport. If you get even a small amount of pension credit, you can unlock a chain of other support. A full reduction on your council tax bill, free dental treatment through the National Health Service, help with your energy costs through the Warm Home discount, and eventually a free TV license when you reach 75. The average council tax saving for an eligible pensioner household runs to around £31 a week, which is over £1,600 a year. Miss the pension credit claim, and you miss all of that too, and it goes further than most people realise. Pension credit also acts as a gateway to cold weather payments, which are made automatically when temperatures drop. It can help with hospital travel costs. In some areas, it opens up additional local council support that wouldn't otherwise be available. These amounts aren't always huge individually, but they add up across a year, and none of them require a separate application once you're on pension credit. They simply arrive because you've unlocked the door. This is not about judging anyone for not claiming. The system is genuinely confusing. Even the most careful planner can miss something that's buried across multiple government departments with different eligibility rules. You're not the problem here. The system is designed in a way that makes it easy to assume you don't qualify, even when you do. So let's zoom in on a real example. Not a textbook case, but the kind of situation I hear about regularly. A couple who thought they were too comfortable to qualify for anything. They weren't. Let me introduce you to Jack and Sylvia. Jack is 67, recently retired from warehouse management. Sylvia is 65 and took time out of work to raise their children, which left gaps in her national insurance record. They rent from the council, paying £110 a week in rent. They are careful with money, they have £8,000 saved, and they have never once claimed any kind of state support. Their combined income is £320 a week. That is Jack's full state pension of £230 and 25 pence a week, plus Sylvia's reduced state pension of £89 and 75 pence a week. She gets less because of those national insurance gaps from her years at home. Now, Jack's position is this. We've got £320 a week coming in, we're not on the breadline, we get by. And he's right that they get by. But getting by and getting what you're owed are two different things. The pension credit guarantee threshold for a couple is £363.25 a week. Their income is £320. That means they fall £43.25 short of the threshold each week. That £43.25 is what they could be getting from pension credit, and because their savings are only £8,000, which is below the £10,000 disregard level, those savings are completely ignored in the calculation. So that's £43.25 a week, roughly £2,250 a year, that they've never applied for. But it doesn't stop there. Because they're now on pension credit, they become eligible for full housing benefit, which can cover their rent of £110 a week. There's no savings cap when you're on pension credit, so their £8,000 doesn't disqualify them. On top of that, they qualify for a full council tax reduction of around £25 a week. All told, pension credit, housing benefit, and council tax reduction together add up to £178.25 a week in combined support, just over £9,000 a year. Now, the housing benefit pays the landlord directly rather than arriving as cash in their hands, but even the cash gain from pension credit and the council tax reduction alone is £68.25 a week. That's more than £3,500 a year. Jack told me he'd never even looked at the council tax support form because it said benefits on the front. He said, "I've paid my way my whole life." I understood exactly what he meant. That one word cost him £3,500 a year in cash support and a further £5,700 a year in rent assistance he was owed. Now, you might be thinking, that's fine for Jack and Sylvia, but I have more savings or a private pension. That's what we're going to cover next, because this is where the confusion really starts. This is the part that trips up more people than almost anything else. I'll be honest, when I first read the pension credit rules properly, it took me 3 readings to understand that there are 2 completely separate savings thresholds, and that confusing them can cost you thousands. Here's how it actually works. For pension credit, the first £10,000 of savings is ignored entirely. It doesn't count as income. It doesn't affect your eligibility. If you have exactly £10,000 set aside and nothing more, the calculation treats it as if it doesn't exist. Above £10,000, every additional £500 of savings is treated as if it generates £1 a week of income. So if you have £15,000 in savings, the first £10,000 is ignored, and the remaining £5,000 is divided into 10 lots of £500, giving you £10 a week of deemed income added to your actual income. That's not a fortune, but it does move your total up, and it could push you just over the pension credit threshold. But here's where the second threshold comes in, and this is the piece most people miss completely. For housing benefit, if you are not on pension credit, there is a hard savings cap at £16,000. Save more than £16,000 and you get no housing benefit at all. That sounds final. But if you are receiving pension credit, that cap disappears completely. There is no saving ceiling, which means that even a small pension credit award, even £5 a week, can change your eligibility for housing benefit entirely. So if you have £18,000 in savings, you might assume you're out of the running for everything. You might not be. If your income is low enough to qualify for even a minimal pension credit top-up, the savings cap on housing benefit no longer applies to you. The bias I see constantly here is what I'd call all-or-nothing thinking. People see a savings figure above £10,000 and decide the door is closed. But the taper is gradual, and the interaction between pension credit and housing benefit creates an opening that very few people know about. There's another version of this confusion worth mentioning. Some people have savings in both a cash account and a stocks and shares account, and they're not sure whether both count. For pension credit, the calculation looks at your total capital, savings, investments, the value of property you don't live in, everything except your own home. If you have £6,000 in a cash account and £7,000 in a stocks and shares account, Your total capital is £13,000. The first £10,000 is ignored. The remaining £3,000 generates £6 a week in deemed income. That's the number that gets added to your actual income for the purpose of the calculation. The system doesn't explain this clearly. That's the problem. But once you understand how the thresholds and the taper actually work, the situation usually looks a good deal more hopeful than the initial assumption. I want to step back from the numbers for a moment and talk about the thing that actually stops people from acting on any of this. Because it's not the complexity of the rules, it's not the forms, it's a word. Independent Age, which supports older people across the UK, found that close to 4 in 10 eligible pensioners are not claiming pension credit. That's not because they don't have internet access or can't fill in a form. Most of them are perfectly capable of doing both. What stops them is the same thing that stopped Jack. It's the label. The word benefit carries 40 years of cultural meaning in this country. It conjures images of people who couldn't support themselves, not people who worked a full career, raised a family, and paid national insurance contributions every single month for decades. When you've spent your life thinking of yourself as someone who provides for themselves and their family, being asked to claim a benefit feels like a contradiction. It feels like admitting something. But what you're actually admitting is that you're eligible for money from a system you funded. That's not a contradiction. That's a return. Here's a practical reframe that I've found helps. Next time you see the word benefits on a government form, replace it in your head with national insurance top-up. Not because that's exactly what every scheme is, the rules are more varied than that, but because the mental shift breaks the emotional block. The council tax reduction you might be missing is not charity. It's support you've already paid for. Calling it something different doesn't change what it is. The average council tax saving for an eligible pensioner household is around £1,600 a year. That's what one word is costing people. Not a mistake on a form, not a missed deadline, just a label they decided didn't apply to them. Now I know the next objection. Fine, Arthur, but those forms are 48 pages long. That's what we're going to sort out next. Let's talk about the second wall most people hit after they get past the identity barrier. Forms. The pension credit application isn't actually 48 pages, but the attendance allowance form used to be close to it, and that alone put people off before they'd even started. I know because I've heard it repeatedly from people who wanted to claim and simply couldn't bring themselves to sit down with something that long. Here's what I'd suggest instead, in 3 simple checks. The first is to use the benefits calculator on gov.uk. It takes about 10 minutes to complete. It's anonymous, and it gives you a working estimate of what you might be entitled to across multiple schemes at once. You don't need to gather every document. You just need rough figures for your income, savings, and housing costs. 10 minutes could tell you whether it's worth going further. The second check is the pension credit application itself. You can do it online through gov.uk or by calling the pension credit claim line directly. The phone option is often easier than people expect. A real person walks through the questions with you. It takes around 20 minutes. You can also backdate a claim by up to 3 months, so don't let the thought of not having done it earlier stop you. The third is the attendance allowance application. If you or your partner has a health condition that means you need help with daily living or supervision. The important thing here is that attendance allowance is not means tested. Your income and savings make no difference to whether you qualify, and the form is now available online through gov.uk, which makes it considerably more manageable than the older paper version. A viewer wrote to me not long ago about this. She'd attempted the attendance allowance paper form 3 times and abandoned it each time. She didn't consider herself someone who needed care, she just had arthritis that made certain tasks difficult. When she completed the online form, she was awarded the higher rate. That's £108.55 a week. In a year, that's over £5,600 completely tax-free, with no impact on any other support she was receiving. One thing worth knowing about timing: for pension credit specifically, you can claim up to 4 months before you reach state pension age, which means you can get the paperwork sorted before the day you actually need it. If you're approaching that point and haven't looked at this yet, that's a useful window to know about. For attendance allowance, there's no backdating. The awards starts from the date of your claim, not the date your condition began. So waiting is one of the few things that genuinely does cost you money. If you're someone who has worked hard all your life and just wants to make sure you're not missing what you've earned, that's the point of this channel. I put out a video every week on exactly these kinds of retirement questions. If that's useful to you, the subscribe button is there. But before we wrap up, there's a trade-off you should understand before you claim. And most other videos about this topic skip over it entirely. Here's the thing that most videos about pension credit don't tell you, and it's worth knowing before you claim. When you receive pension credit, that extra income gets counted in the housing benefit calculation. So if claiming pension credit means your total income goes up, your housing benefit can come down. The taper rate is 65p in the pound, meaning for every £1 of additional income above a certain level, your housing benefit reduces by 65p. Let's put some numbers to it, because this is the part people find alarming until they do the maths. Say you're a renter currently getting £110 a week in housing benefit. You're then awarded £50 a week in pension credit. That pension credit gets treated as income in the housing benefit calculation. The reduction is £50 multiplied by 0.65, which works out to £32.50 a week less in housing benefit. So you gain £50 from pension credit, but your housing benefit drops by £32.50. That's a net cash gain of £17.50 a week from pension credit alone. And on top of that, you've now unlocked the passport benefits, the council tax reduction, the warm home discount, the free dental treatment. None of those get eroded by the housing benefit taper. The point is this: the interaction between pension credit and housing benefit is not a reason to avoid claiming. It's a reason to understand what you're claiming before you do it. The outcome is still a net gain every time, but the gain looks different from what you might expect when you first see the headline figures. Not claiming because you're worried about a clawback is like refusing a pay rise because you'll pay more tax. You always keep more than you give back. Now, what happens if your health changes in retirement? That's where the next piece comes in. And unlike everything we've covered so far, it has nothing to do with your income or your savings. Everything we've covered so far, pension credit, housing benefit, council tax reduction, those all depend on your income and savings to some degree. Attendance allowance is different. It doesn't depend on either. Attendance allowance is paid to people over state pension age who have a physical or mental disability and need help with personal care, or who need supervision to keep themselves safe. Your income doesn't affect it. Your savings don't affect it. Whether you own your home or rent, whether you're a higher rate taxpayer or have no income at all, none of that changes your eligibility. The only question is whether you need the care. There are two rates. The lower rate is £72.65 a week and covers people who need help or supervision during the day or the night. The higher rate is £108.55 a week and covers people who need help or supervision both day and night, or who are terminally ill. Take Jack from our earlier example. He has arthritis that makes bathing and dressing difficult without help from Sylvia. That care need, which Sylvia provides without a second thought, makes him eligible for the lower rate. That's £72.65 a week, or just under £3,778 a year, tax-free. And because attendance allowance is disregarded as income for the purposes of pension credit, claiming it doesn't reduce anything else they receive. The threshold for qualifying is lower than most people assume. If you or your partner rely on someone else, even informally, for help with daily tasks, it's worth looking at the criteria carefully. Many people underestimate the help they've come to depend on because it's become routine. Right, Let's bring everything together. Before you go, here are 3 numbers worth writing down, because these are the ones that tell you whether any of this applies to you. Number 1, the pension credit guarantee threshold. If you are single, that threshold is £238 a week. If you are a couple, it's £363.25 a week. If your total income from state pension, private pension, or any other source comes in below that figure, you are likely entitled to pension credit, and by extension, the passport benefits that come with it. Number 2, the £10,000 savings boundary. Below that, savings are ignored completely in the pension credit calculation. Above it, there is a gradual taper rather than a hard cut-off, and critically, if you qualify for any pension credit at all, the £16,000 savings cap on housing benefit disappears entirely. That's the hidden lever most people never find. Number 3, £108.55 a week. That's the attendance allowance higher rate. It doesn't matter how much you earn or how much you have saved. If your care needs meet the criteria, you can claim it, and it won't reduce anything else. I don't know every detail of your situation, but I do know that the rules exist for a reason, and the rules say that a lot of people watching this are entitled to money they're not claiming. Don't let pride or uncertainty stop you from finding out. It costs nothing to check. If this video has been useful, subscribe to the channel. I'm Arthur, and every week I help people like you work through the UK retirement system without the jargon. Click the button below, it's free, and it's there to make sure you don't miss what you've earned.